Hey, what's going on, traders? Hope you guys are doing great today. This is Chris from Verlo Trading, going to bring you another educational piece of content here. Today we're going to talk about the pattern day trader rule. So I've been doing some research on it, and there is also a number of other videos on the internet and articles you can read about the pattern day trader rule. But in this video, I'm going to talk about the pattern day trader rule and also give you my thoughts about it and how I think it limits newer traders from learning the things that they're supposed to be learning in day trading. So let's get to it. If you enjoyed this content, smash the like button, and that's what it's all about. So I'm going to reference a number of articles here. The first thing I want to say is that if you do live in Canada and if you have an account with, for example, IB in Canada, you need to know that there is no pattern day trader rules. If you do have an account with a broker in Canada, there is no pattern day trader rule in Canada. So if you have an IB margin account, it's not going to be affected by the pattern day trader rule at all. You can also see this if you go into your TWS platform and go into your account window. In this area right here where it says available for trading, if your account is subject to pattern day trader rule, you should see boxes down here that talk about pattern day trader. And I'm going to click on this question mark right here, and it's going to bring me to this page on IB's website. And if you scroll down a little bit, you'll see exactly that, day trades left. So this applies to the pattern day trader rule here. If you look on the right side here, there's a little note that says not applicable for futures. I'm going to refer to this later in the video as well. Okay. Hey guys, if you stick around to the end of this video, there's going to be a secret strategy towards the end of the video. So stay tuned for that. Also, it's not going to be a mind-blowing strategy, but it might be something that you didn't know before. So stick around. See you later. So the pattern day trader rule, let's get to it right now. What is it? So basically, it's a rule that was put in place by the regulatory agencies, FINRA. It was put into place in the year 2001, and it just so happens that this lines up with the dot-com bubble, which is kind of interesting. But basically, it is a minimum equity requirement for opening and closing trades during the span of 5 business days. So the rule basically states this: a pattern day trader rule is a regulatory designation for those traders or investors that execute 4 or more day trades over the span of 5 business days using a margin account. What this rule is stating is that you cannot take more than 4 trades over the span of 5 business days, or your account will be flagged as a pattern day trader account, and then they can lock you out. Now, certain brokerages, if you read on their documentation a little bit, they actually tell you, for example, IB, I'll read this to you. The NYSE regulations state that if an account with less than 25,000 USD is flagged as a day trading account, the account must be frozen to prevent additional trades for a period of 90 days. We have created algorithms to prevent small accounts from being flagged as day trading accounts. To avoid triggering the 90-day freeze, we implement this by prohibiting the 4th opening transaction within 5 days if the account has less than 25 grand USD in equity. So basically, you can only take 3 day trades open and closed within the span of 5 business days. They're saying it here that they will prohibit the 4th opening transaction here if your account balance is less than 25,000. Now, a couple of things you got to know about the pattern day trader rule. This applies to stock trading and options trading. It does not apply to futures trading. So if you read a little bit more about pattern day trader rules, they talk about this round trip. So a day trade, according to this rule, is when a trader opens a position and closes the same amount of position that they opened. Now, depending on the broker, there might be some exceptions to how you can do things. But generally speaking, let's say a trader buys 300 shares of a stock in one trade and then decides to use 3 separate sell orders of 100 shares each to exit that position. So for example, let's say they bought it at $1, 300 shares, then they sell 100 at $1.10. They sell another 100 at $1.20, and they sell another 100 at $1.30. That is perfectly fine and only categorizes as one day trade. Let's say our trader starts doing things that are more advanced, like let's say they have a buy order and then their sell order fills, and then they have another buy order, and they're basically providing buy orders and sell orders on both sides of the market at all times. Well, that's going to be categorized as day trading. So every time you have a sell order that's matched with one of your buy orders, that's going to be considered an individual day trade. So for example, if I submit a buy order at 14.64 and then the market fills my profit taker at 14.77, that's going to be considered one day trade. Now, even if I had, for example, another bid down here, if it fills my second buy order here, that's going to be considered my second opening transaction according to the pattern day trader rule. Now, in case you were wondering, I'm actually looking at a futures contract here, and the pattern day trader rule does not apply to futures. I'm actually looking at the 10-year yield futures, which trade on the small exchange here. This is what it looks like on the order book. And right next to it, I'm looking at the 10-year note futures, which trade on the board of trade here. And I'm looking at them next to each other because they're directly opposite products. You can even see that on the charts here on the left side. Let's get back to the pattern day trader rule. So like we were saying before, if you have an account with IB is not even going to let you take that fourth day trade, because they're going to see that if you do take that fourth day trade, your account is going to be flagged as a day trading account, because then there's a chance that your account can get frozen. You can't even put on any trades unless you meet that minimum equity requirement of $25,000 US. Okay, let's talk very briefly about the $25,000 equity requirement. Now, from the point of view of a retail trader, I do not believe that learning trading requires a lot of money, and it does not require anywhere near $25,000. So that's why I think that this number right here is 100% arbitrary. It has nothing to do with trading, because I'm going to make the argument that I believe this is a fact, that traders who are just learning about the markets and learning about how to implement their strategies and learning about how trading affects them, their bodies, their minds, and everything, they do not need to be trading with a large amount of money. You can be trading with an account of a couple $1,000. Maybe you're risking $20, $30 per trade, maybe even less. You do not need to be swinging lots of 100, 200, 500 shares, because you're still learning trading. And you will know that in the first year, 2, 3, 4, maybe even 5 years of day trading, you're going to experience a lot of inconsistency in your results. And if you don't believe me, that's fine. I'm just telling you because I've had the experience of doing it myself. So basically, this $25,000 requirement, it totally makes no sense at all from the perspective of a trader. And what it's doing is it's encouraging traders to do this. I believe that this rule is part of the greater scheme of the financial industry, which is to, number one, get traders to hold positions overnight more and to hold trades more in general. Now, in case you didn't know this, but the majority of money being made on an intraday basis is being made by high-frequency traders and scalpers. You don't have to believe me on that, but if you watch the NASDAQ or the S&P on a daily basis, you'll be able to see this as well. If the majority of money in the market is being made from smaller movements and smaller, shorter time frame trading, then why are these guys trying to tell you you need $25,000 to day trade in an account? Well, that's the big misconception right there. These guys want you to hold your trades longer so that you wake up the next morning and you have to either panic because you're down a lot of money, or you have to panic to close your trade because you're maybe up a lot of money, or maybe you're break even, who knows. If you're holding trades overnight expecting the market to go up the next day, that is, in my opinion, equivalent to gambling. There's a lot more risk doing that compared to using futures contracts to scalp or learn scalping to begin with, okay? So here's an example. I'm looking at the 10-year yield futures trading on the small exchange. If you don't know what that is, you should definitely check it out. I'll show you my watch list really quickly for the small exchange. All of these symbols are available on Interactive Brokers. I've just imported them into Sierra charts here, but I can show you in my IB watch list, they're exactly the same right there. All right, guys, so if you made it to the end of this video, I'm actually gonna show you a strategy that you can practice on futures, because futures are not subject to the pattern day trader rule. So if you waited this long, congrats. Now I'm gonna show you a strategy. So this is how the strategy works. The first thing you need to do is you need to figure out the average movement of your market. What is the one standard deviation movement? So on average, how much is the market moving? You can determine this by simply looking at the size of the rotations, or you can use other tools, like for example, a standard deviation plotted onto a range chart. And in this case, this standard deviation is measuring 21 bars worth of price action. If you want to smooth out the data even more, you can apply a moving average to that standard deviation to get an average of the standard deviation over the specified range of prices. Again, I know I'm getting pretty advanced here, but this is how it works. You figure out, number one, where the market is trading. So let's say, for example, right here, I'm looking at the 10-year yield futures on the small exchange. You can see here that the majority of volume has traded right around $14.68. So what I'm going to do now is I'm going to look at what the standard deviation is telling me here. This standard deviation is measured over the last 21 bars on this range bar chart here. So it's telling me that on average, the market is moving and rotating around 25 cents at a time. You place a buy order or a sell order roughly around 25 cents away from where the market is currently trading. So if we're trading at say 14s and 68s, you're going to go to 1468s and go 25 cents below that. So 20 cents down to 48s and then 5 more cents down to 43. So I'm going to place my bid down at 43s. So your risk on this trade is actually going to be half of your 1 standard deviation move. And that might not even be your actual risk. Actually, you might be able to cut the trade before that amount is breached, although that is what I will consider to be the scratching range. So that is what you're going to use to manage your risk in this strategy. So if your 1 standard deviation is 25 cents, then 12.5 cents should be your scratching range. If that is breached, then you're probably wrong and you should take the risk and get out. And the profit target would be back to where the market was previously trading. So this is not a recommendation to trade. I was just sharing with you an idea. It's up to you to see if this idea will fit your trading strategy. And that is going to be it. So guys, if you enjoyed this educational video, leave a comment down below and I'll catch you in the next one. Take care. Bye.